The two-year Treasury yield just hit its highest level since early 2025. And if you know what that means, you know the economy just got a major warning signal. Treasury yields don't just live on Wall Street trading desks. They ripple through every corner of the American economy. Your mortgage rate, your car loan, your credit card, your savings account, and your stock portfolio. In the next 10 minutes, I'm going to break down exactly what happened to Treasury yields this week, why it matters, and what a market that's now pricing in a 75 basis point rate hike by the end of 2026 means for every dollar you own. Because this is bigger than a number on a bond screen. This is the market telling you where the economy is headed before it gets there. Let's start with what Treasury yields actually are. When the U.S. government borrows money, it issues Treasury bonds. Investors buy them and earn interest. The two-year Treasury note reflects what investors think the Federal Reserve will do with short-term interest rates over the next 2 years. When that yield rises, it means the market expects rates to stay higher or go even higher for longer. This week, the two-year note rose above 4.22%. That's the highest it's been since early 2025. Why did it jump? Because the Federal Reserve's June meeting changed the math. New Fed Chair Kevin Warsh held rates steady at 3.50 to 3.75%, but his press conference sent a clear message. The Fed is not done. 9 of 18 policymakers now expect at least one rate hike before year-end. 6 expect 2. And the Fed's own projections pushed any rate cuts into 2027 at the earliest. Markets heard that message and repriced immediately. The probability of a 75 basis point total hike by December 2026 jumped significantly. That's the market pricing in a Fed that is more hawkish than almost anyone expected at the start of this year. To understand why this matters, you need to understand the transmission mechanism, how Treasury yields flow into your daily life. Mortgage rates follow the 10-year Treasury yield, not the Fed funds rate directly. But when the two-year yield surges, it signals that short-term rates will stay elevated, which pushes long-term yields higher too. The 10-year Treasury rose this week as well, and mortgage rates, already above 7%, could push higher. For anyone trying to buy a home right now, this is brutal. A 30-year fixed mortgage at 7.5% on a $400,000 loan costs roughly $500 more per month than the same loan did when rates were at 5% in 2023. Car loans are also directly impacted. Auto loan rates track short-term borrowing costs. A new car loan today runs around 8% for a 60-month term. That's near the highest since 2008. Credit card rates are even worse. The average credit card APR is now above 22%. Every month you carry a balance, you're paying rates that haven't been seen since before the smartphone existed. On the positive side, if you have savings, high-yield savings accounts, and money market funds are now yielding 4 to 4.5%. That's real money for cash holders. Treasury bills maturing in 3 to 6 months offer similar yields with zero credit risk. Now let's talk about what this means for stocks. When yields rise, the math for stocks changes in a fundamental way. Higher yields mean investors can earn more from safe assets, treasuries, money markets, without taking equity risk. That reduces the premium investors are willing to pay for stocks. This is particularly dangerous for growth stocks, technology companies, whose value comes from future earnings. The higher the interest rate used to discount those future earnings, the lower the present value of the stock. It's no coincidence that the Nasdaq underperformed last week as yields spiked. The S&P 500 is also vulnerable. Nearly one-third of S&P 500 earnings come from financial sector companies that benefit from higher rates, but the other two-thirds face headwind as borrowing costs squeeze margins and consumer spending. Goldman Sachs strategists issued a note this week warning that if the 10-year Treasury yield rises above 4.5%, equity multiples will compress meaningfully, meaning stock prices would fall even if earnings stayed flat. So what should you do with this information? If you have variable rate debt, HELOCs, adjustable rate mortgages, credit card debt, this is a warning. Rates are not coming down soon. Every month you delay paying off high-rate debt costs you more. If you're a saver, the opportunity in short-term treasuries and high-yield savings is real. 4% on cash is not to be ignored. If you're invested in stocks, watch the 10-year yield closely. It is the single most important number in financial markets right now. The 2-year Treasury hitting 15-month highs is the bond market speaking plainly. The Federal Reserve is not done, inflation is not conquered, and the cost of money is staying high. Subscribe for daily coverage of the economic signals that matter. We post every single day, so you never miss the move that changes everything. I'll see you in the next one.